Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right. No extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Adam Link. Adam is the founder of Fireweed Capital. He also has a background with a bachelor's in finance, a master's in cybersecurity, and a doctorate in computer science. He holds a CFP designation and has personally invested in stocks, bonds, 500 plus apartment units, real estate syndications, and even done some angel investing. Adam, I am looking forward to today's conversation. Welcome to The Wealth Flow.
Likewise. Thank you so much for having me.
Absolutely. Always love to start with each person's story, where they grew up and what eventually led you into this world of, finances and investment. Because your story didn't start that way, or at least your work story. So if you could share with the audience those details, that would be fantastic.
Yeah, certainly. Well, I've got a pretty diverse background, and I think that's actually been a very positive development for me now later in life. So, yeah, we'll start with kind of my formal education. I learned best through formal education, so that's why I've gone all the way up to having a doctorate. For me, it's very easy to reach out to the academic system and say, here's a skill set that I want to learn and develop. What formal training is there? So I've done all sorts of certifications and obviously bachelor's, master's, and a doctorate. I got my start really by doing finance in college. And I was kind of torn between going the IT route in college and going the finance route in college, more the business route. Ended up doing business because that was, something you get a degree in business, you go work in corporate America, you make your money, save your money, and eventually you retire, right?
Yeah.
IT at that point in time was like, well, you go into IT if you want to learn how to fix printers. And, I want to do something more than that, right? So I said, okay, well, I'll go do finance. No offense to any of the accountants out there, but I was also looking between accounting and finance. And the story I was told by one of my advisors was, if you want to learn how to score the game, you go accounting. If you want to learn how to play the game, you go finance.
Yeah.
And I wanted to be, the one playing the game. I didn't want to just be sitting there on the sidelines scoring the game. So I went with finance, specifically capital markets finance. And that really did make a large amount of difference in the way that I think about my investing and my own wealth, because capital markets finance deals with stocks and bonds and public markets. It's different than corporate finance, which deals a lot with how do you get positive internal rate of return and net present value on corporate projects. Coming out of school, I actually graduated during the Great Financial Crisis. Jobs were scarce. Housing was cheap. This is the days when you could buy a block of houses in Detroit for $100. So for anyone coming out of school now thinking, well, the economy's never been this bad. The economy is always this bad. About every 10 years or so, the economy is always this bad. Sometimes even more frequently. And so came out in a downturn, did some odd jobs here and there to make ends meet. Ended up, getting a couple of jobs that you would call your normal W-2 jobs. and really tried to stick with those. As it turns out, I wasn't a great W-2 employee. I kind of job hopped around, whatever was an interesting job for the first probably I'd say 4 or so years after college, and that basically led my grandfather at one point to ask my dad if I was ever going to hold down a stable job. Because what they did back in those days, right, was you go to one company, you stay with one company for 20 years, and then you get your gold watch and you move on. I moved around a lot. I tried out different industries, tried things that I liked, things that I didn't like. Ended up doing the startup path, and really where a lot of the story kind of kicks off is I was actually working a full-time job, and my friend and I built an app. And after we went live on a website, about 2 weeks later, we got approached by a company to buy the application. And this almost never happens, right? This is the element of luck in every entrepreneur's story. And we happened to get acquired by a company out of California who had deep pockets. They were kind of a startup studio, and they were looking to build a mobile application development arm. And so we got acquired, and we became kind of one of the 3 apps that they started to build around. We ended up shutting down our app. I ended up working as a back-end engineer in tech for, at that point, one of the top 10 social media apps in the US, which was an incredible opportunity to see scale. That got me into tech, got me back into tech hardcore. And so I kind of stayed as a back-end engineer for a number of years, and over a decade, actually, in tech. That was a lot of the time where I was in the startup scene, right? I was near small companies. And so for me, angel investing and, seed rounds, venture capital, those were just things that I knew angel investors. I knew people who were professional venture capitalists. And so it was kind of like, well, those groups. And so you kind of invest with them. And then, ended up kind of throughout all that, still doing financial stuff, right? Whether it was investments or helping people think about, where to invest their money. Giving presentations to my coworkers, talking around 401ks and stuff. And I said, you know what? I should get paid for doing this. And so I went and became a licensed financial advisor. And so, Fireweed Capital, that's what I do now as a financial advisor. Basically help folks, specifically those with a background in tech, with families to, how to match their money with their goals and live the life that they want to live, using their money. And so that has also given me a whole lot more information on how to think about investments. Of course, again, professional training. And then within the wealth management side, I went and got my CFP, which is a certified financial planner. And so it's a whole nother level then of understanding how to grow and build wealth and preserve wealth within the confines of the U.S. system. So that's kind of how I ended up where I am today.
Wow. Okay. No, it's very interesting, and it's a good kind of audience to target. Tech employees, typically higher income, but also not a lot of time in a lot of cases, long hours, that kind of thing. Tell us a little bit about maybe some of the things when it comes to, if you're going to advise somebody with Fireweed Capital, what are some of the picture that you look at, and some of the kind of first couple things that most people need to know when they start to think about their investments and their finances?
Yes. So one of the first things I actually look at is philosophical alignment. There are people out there that are DIY investors, do-it-yourself investors. And folks like that are generally not going to be a fit for a financial advisor, just frankly because they want to do it themselves. Right. And in much the same way that if you're a construction company, you are very unlikely to sell somebody on a construction project if they want to build everything themselves. Right. Some people like to tinker and build stuff on their own, and no amount of selling is going to make them come over to your company because they just want to build it. Right. They find joy in building it themselves. Right. The second thing on philosophical alignment I look for is, Fireweed Capital, we believe in active risk management. So we take positions in the market. We believe that you can see warning signs. We are not passive investors, right? We don't just buy and hold the market and say, well, you're going to just have to stomach through a 30% drawdown. Some folks don't want that, right? They just want passive investing because it's cheap, because they just buy and hold, right? These are the folks more like the bogglehead type who are looking at, what can I do with 3 funds and set it and forget it, and I'll retire. And that's great, right? Folks like that, they're very fee sensitive. And we look for folks that believe that there's more that you can do in the market than just slash your fees. So that's really an abundance mindset. So that's kind of the first thing we look for, right? And the reason I bring that up is when you look at your own portfolio, it's important for you to understand how you view investing when you go out and try to find an advisor. Because for some people, I just described my practice and they're going to say that sounds exactly what I want. And other people will say that is not at all what I believe in the market, right? And the thing with finding an advisor is you want to find somebody that believes what you believe, who will give you advice that matches your investment philosophy. Right? Because if you have a mismatched philosophy, no amount of them being right is ever going to convince you that it's a good idea when you're down, when the market's doing something weird and they're telling you something that just doesn't feel right to you. Right? Yeah. So that's like the number one way you can blow up your own financial plan is just not listening to your advisor because you've got a mismatch. And then beyond that, quite frankly, the secret to getting rich is make more than you spend. And you'll notice the way I said it, it's not, save more, or it's not, spend less than you make. It's make more than you spend. And that mindset means we've got to think about increasing revenue to your own bank account rather than cutting costs and cutting your expenses, right? Don't live within your means, make enough money that you can live the life that you want.
Yeah. I like that philosophy a lot better than some of the ones, where you are trying to budget just to kind of not scrape by. In some cases, it's more than just scraping by, but, want a little bit of excitement, so.
Exactly. Yeah. No one really wants to eat rice and beans just so you can retire at 50.
Right.
It's like, well, rather than doing that, let's budget in a steak dinner every week and then figure out how we get enough money so you can still retire by 50. Yeah. Right? Like do both.
Exactly. Well, let's talk about that then. Let's talk about ways that you can. Most people, when they think about increasing revenue, they think about, my current employer, potentially getting a raise, maybe learning some new skills that's going to attribute to some of that. And of course, there are those routes, and that is a real thing to get additional skills and to get an increase in income from that standpoint. But what are some ways that somebody can do that outside of maybe their W-2 or what they're doing for a job?
Yeah. So what I'd say the first thing on your W-2 is never be afraid to job hop and never be afraid to ask for more. To give you a sense of this, I think I doubled my income every 2 years for about 6 or so years in my career. And I did that by job hopping. And every time somebody asked, what's the salary you want? I always said 2 times the previous job's salary. Yeah. I heard, in negotiating, right, like especially with salaries, that first number, it's an anchor number. And I figured, if we're going to anchor somewhere, we're going to anchor high. Yeah. And so I would say 2x my previous salary, right? And crazy that is to say that, that's ridiculous. And every time I said it, I got it.
Yeah.
Right. And so you want to talk about increasing wealth real fast? Just do that. Right. And the worst thing they say is no, and you say where you are. The best thing that happens is you just doubled your salary. Right. Like that's huge. Right. Now, it doesn't always work like that in every field. Certainly you have to have a certain amount of skills and all that, but you can always ask for more. The next thing then, like you had mentioned, really upskilling and investing in yourself. But I think that the way you have to look at this is where is the maximum utility of every marginal dollar you can spend? Now, it sounds really academic, but essentially what it means is if I've got $1 to spend, where would I spend that to get the most benefit for myself? And in this case, the benefit we're talking about is increasing your income. So where do you spend that dollar, right? You can spend that dollar on training, making yourself a more valuable product. Now, it only matters if you can actually sell yourself at a higher rate, which is getting more income from a W-2, right? If you're going to go get all these new skills and credentials and certifications and it never translates into an increase in income, that was pointless money, right? You didn't earn anything extra. And so you have to look at what is my return on investment of investing in myself? Or can I take that and go out to a real estate investment, right, where I can get 10 to 15% internal rate of return, right? No guarantees there, but again, is this something that I can make more money on? Can I go to the stock market and get a return there, right? Can I maybe invest this in some sort of a bond fund or a real estate investment trust and get income? And what you should be thinking really is that marginal dollar, where can I invest it to get the maximum return? And then on top of that, where can I invest it to get the maximum return that I can control? When you look at some of the great investors, like folks who invest in the stock market love to look at like Warren Buffett.
Mm-hmm.
Right? And they say, well, Warren Buffett invests in stocks. He does a great job and he's a great stock picker. He is not a great stock picker. Warren Buffett is a great operator. He buys enough of a company that he can control it, streamline their operations, and run it. That is very different than buying $1,000 of Apple shares, right? And so you have to then look at that and understand what he's doing is operating. He's not stock picking. He's finding a company, he's buying it, and he's operating it. So yes, you can invest in real estate. You can buy a real estate investment trust, or you can buy a single family home and rent it out. Right? That's the difference between being a stock picker and being an operator. Now, being an operator is a lot more work, right? If you just invest in a REIT, you turn around and you collect your check every quarter, every month, however often they pay out. If you're a single family home owner, you are probably the person answering the phone at 2 a.m. when there's a leak, and you are probably either going over there to fix the leak or finding a plumber. But either way, it lands on your shoulders. So you get paid more, you get the higher return percentage, you can control your own destiny, but you are giving up time. Your Saturdays are now dealing with tenants.
Yeah. Yeah, very true. I understand that personally.
Yes, as do I.
Wealthflow audience, pardon me for a quick interruption to today's show, but I have some exciting news that I want to be sure that all of our listeners are aware of. We just launched 3 totally unique to the market funds that are at the cutting edge of technology and AI. We have combined my 25 years of real estate experience and my recent work as VP of development for a tech company to bring 3 awesome investment options to our audience. For full details, go to our website at bobocapitalventures.com. Again, that is BOBO capitalventures.com. All right, back to the show. But, you don't spend near as much as you might think in your nightmarish version of what it could be, although there are times when that nightmare does show its face from time to time. So,
exactly. Yes. Yes. Plenty of war stories.
That's right. That's right. I think that's great. It was a great place to start with kind of the idea of moving around and hopping around on the job. Unlike years ago when I look at really the way my dad kind of played, his career was being loyal to a certain company for X amount of time, and unfortunately, late in his career, he was let go and left trying to find another position. Extremely qualified, and at that late in life, it became a little bit of a challenge. So I don't think that there's any, brownie points necessarily, gold watch for sticking around and, really having that loyalty to a specific company. And I've also seen just in my personal life where somebody's maybe left one company, went to another one for a higher paid position, a higher paid title as well. And then eventually actually was rehired by the original company that they left, but hired in a, probably 3 or 4 times higher, position than where they were when they left that company. So it gives you some room for negotiation to, be able to have that flexibility to leave versus just waiting for a, 10% or whatever annual 15% or whatever it may be that you're anticipating to get. So I think that's great.
Yeah, exactly. The concept of loyalty, there used to be a world, and certainly before my time, where the company looked out for you.
Yeah.
And I think when you look at manufacturing heavy companies where there is on-the-job training you have to do in order to be proficient, there is a desire to keep good workers. And of course, every company is going to say, well, we want to keep good workers, right? At the end of the day, though, your loyalty truly needs to be to yourself. And if you have a family, know your family, right?
Yeah.
Like that's really all that you should really be caring about. Now, obviously care about your company while you're there, but also be very realistic that when times get tough, they will cut to keep the company alive. And if you're not the CEO and you're not the one making the calls to cut, you're potentially being cut. And so go in it with both eyes open and say, well, that's as far as my loyalty will go. If working nights and weekends is required to get ahead, great, do it. If you like doing it, great, do it. But don't do it and sacrifice your family time, because what are you going to get when they cut you, right?
Mm-hmm.
You don't want to look back and say, I put in 20 years and they cut me. It's like, well, should have been in all those baseball games instead,
Exactly. I think there's something huge to be said about that. As far as different investments, are there particular types of stocks or REITs or bonds or anything that you look at from an income producing standpoint? Obviously, you're looking for value to go up, but anything from like a dividend standpoint or something like that that provides a stream of income.
Yes. So we have actually helped a number of clients with dividend portfolios.
Okay.
So this is something that we always keep an eye out for, what is doing well on dividends. One of the things that we found with dividend paying stocks and funds is typically the higher your percentage rate that you're getting out, the higher your risk. Okay, now this sounds obvious, but let me just kind of break it down a little bit, right? Private credit is in the news right now. There's a company called Blue Owl. They're going through some rough times right now with just some of their valuation. I was in BCred, which is, I believe there's a non-accredited version as well. But certainly for accredited investors, there are a lot of private credit funds you can get into. And for those of you who don't know, accredited investor means you got over $1 million in net worth, or you make over $200,000 individually, $300,000 as a couple. A bunch of other alternative investments open up once you're an accredited investor, right? So one of the things that most people don't realize with a lot of these private credit funds is the withdrawal gates that they have. I actually sold my investment in BCred before the whole private credit thing became headline news. And one of the things that I learned as I was trying to sell is, they will only redeem about 5% of the fund, and they will only redeem every quarter. So if you wake up in the morning, you say, I need my, $100,000, $200,000 that's in private credit back. The answer is, well, did you already miss the quarterly redemption window? Because if you did, you got to wait till next quarter. And then you got to put in the redemption. And then you got to hope that you're under 5%, withdrawals. Otherwise, you may not get all your money back. And so a lot of people start to suddenly look at that 13% or 14% or 10%, whatever they're getting in private credit, and say, well, this is great. Why doesn't everyone do this? Well, it's because you just locked up $200,000 to get $20,000 a year. Like, you're not going to get the $200,000 back tomorrow, right? This is a thing you have to plan for and unwind, and then you're going to be paying taxes on any gains. And so, there's a very real lockup risk when you start moving into high income, producing portfolios, right? Same thing with closed-end funds. You always want to read the prospectus before you start buying, especially if you're buying accredited investor only stuff. That's usually where you end up with a lot of these rules gating how and when you can take your money out. Right. When it comes to dividend stocks, I'm a huge fan of the just online dividend aggregators that are out there. There's a bunch of different platforms you can go to for dividend research. I personally look at a diversified portfolio, so 20 or so stocks for dividend producing stocks. It's not the individual stocks that are important, it's the number, right? You want to have strong diversification in a dividend paying portfolio. And really what I'm looking for there is just what's the history of paying dividends. And a lot of times a dividend producing stock is going to fall in a certain number of sectors. It's going to be some sort of a consumer staple or utility or financial firm or insurance firm. You're not going to get the high flying tech stocks in a dividend portfolio. Right. And so really what you're looking for there is, what is the most boring portfolio I can put together that I don't need to think about? Right. You don't want to have excitement. If you're looking at your portfolio for income, you do not want excitement in that portfolio. Right. Nobody gets excited about being able to pay for groceries this week. Right. You should not be excited when you get a dividend. Right. It should just be one of those, you are really, really upset if you cannot pay for groceries. Right.
Right.
So yeah, that's kind of what we look for. Right. It's just, what's boring and normal and steady on the dividend paying side. The other thing I'll leave you with is income portfolios. They are always much larger than you think they need to be. $100,000 is not enough for an income portfolio. in most parts of the US, right? Once you factor in the fact that you're paying taxes, once you factor in the fact that you also have to beat inflation, and inflation is usually 2 to 3%, but sometimes can be much higher. We saw 8, 7, 6% inflation in years past. You got to build that into your model. And so if you think you're going to be retiring and earning money off a $250,000 portfolio, you are likely not.
Yeah.
Right? You're looking at millions to likely actually get an income portfolio put together. So it is a lot more than you actually think you're going to need to escape the trap of taxes and inflation.
Right. No, for sure. How about, what about from an advice standpoint on trying to build the size of your portfolio? If you're, in other words, someone who is, kind of still building at that still building stage versus trying to, take the lump sum that you've been able to acquire over a certain time and turn it into an income portfolio. You still have a lot of growth to go. What are some of the ways that somebody can compound and really see some growth?
Yep. One of the things that we think about a lot at Fireweed Capital is kind of our motto is guard first, compound second. And what we mean by that is basically the first thing you want to do is protect the nest egg that you've built. Mm-hmm. For us, this specifically means looking at a key trait of behavioral finance, that humans hate losing more than we like winning. Mm-hmm. When your portfolio is down, the desire to do something, anything, is incredibly high. And usually when your portfolio is down 20 to 30% is when we see people make their fatal flaw in their entire financial plan that can offset their entire life's goals, which is they will sell when the market's down. Right. Or they will, try to rejigger their portfolio and get into something else, trying to chase, some sort of a win, right? People just want to do something to feel they have some illusion of control. And if you're one of those people, and by the way, most of us are, this is where working with a financial advisor that suits your philosophy helps incredibly, because you're likely to be able to talk to a third party and say, help me do something. And they will say, here's what you can do. And it does not involve selling. Right? At Fireweed Capital, we proactively position our portfolios such that when the market does crash, we are seeking to not crash as much, if at all. Right? What we're really looking for is when the market goes down, we don't want to be down. And the second thing then is, compound second. And so you do have to grow that nest egg. And we don't believe that you should be beating the market every year. In fact, that's very highly unlikely that you're ever going to be able to beat the market multiple years in a row. Statistically, it's very unlikely. So what we try to do is we try to capture as much of the upside as we can. But over the long period of time, by not losing money and gaining as much as we can, we slowly ratchet ourselves to performance that bests our benchmark, because we're not starting as far down after a loss and we're gaining on top of a larger amount of principal, right? So that's kind of like our core investment philosophy, and obviously we implement that, we charge for that, but you can certainly take that away as well and say, okay, well, that's basically what we found to be the secret to making money in your portfolio, right? Don't lose as much as the market and get as much of the upside as you can. And then when you start looking at a wealth engine, right, you start thinking about where's my money coming in and where am I growing it? So if you've got a W-2, right, that's the income stream in your wealth engine. You're looking at taking as much of that W-2 income as you can and breaking it off into a portfolio to grow. And then at that point, you have to kind of decide what your risk tolerance is in that portfolio. But, is that portfolio needing to grow at a level that you need to be incredibly risky, right? Do you have dreams for $10 million and you're sitting on $10,000? Well, you have to hit a certain rate of return every year to hit your goals of $10 million, right? Or you have to save more money, right? And so as you start backing into the math, then it becomes this question of, well, how do I get to where I want to be and what does my return look like? And that's then kind of what we do as financial advisors is, well, here's the return you need. Here's the investments that fit that profile. Are you comfortable with the resulting risk? Because going from $10,000 to $10 million requires that you take a lot of risk or you have a lot of income, right? Like just mathematically, or you hit the lottery, right? But like in the realm of realism, right? It requires a lot of risk to get there. And so then it becomes a question of, well, what are you willing to risk to get that goal? And if you're not willing to take the risk, then that's not a realistic goal for you.
Right. Right. No, it makes sense for sure. How about some other types of investments that you sort of favor that maybe wouldn't be common to what people typically invest in? Is there anything out there that you see in the investing world that you're like, you know what? Not a lot of people know about this, but this is, something that somebody should at least think about for a little bit of their portfolio.
Yeah. Well, I will tell you, a lot of my software engineering experience was in crypto.
Yeah.
If you had been talking to me 5 years ago, I would have said crypto. Um, Realistically, where we are right now, and I'm looking up behind my screen here, I've got a ticker that includes obviously stock and crypto tickers. Um, we have seen Bitcoin do a massive price correction in the last few months here.
Yeah.
If you recall, Bitcoin was up over $120,000. We were flying high. It was the year of crypto, and now we're at, as of this recording right now, 68,000. I have seen multiple big drops in crypto in my career. I've seen people, remortgage their house and lose their money. I've seen, taxi drivers talking about buying into crypto. If you are going to go into crypto, go with eyes wide open. It swings a lot. I know a lot of big advisors now at large, wirehouses like Merrill Lynch, JP Morgan are putting a lot of their clients into crypto for a portion of their investment portfolio. You can certainly do that. I will say I'm not looking at crypto that much anymore. I just don't think that there is an opportunity to go from zero to $1 million. I just don't see that, swing for the fences for the risk. So that's, I know you're looking for what are the things I would invest in. I bring that up because I know a lot of people, when they see the background in crypto and all that, everyone's like, oh, well, why not crypto? Why not Bitcoin? And it's like, well, honestly, you guys, you're not going to be a millionaire in Bitcoin anymore. And so if you're looking for that, right, you're looking for that level of return, honestly, you're looking at things like angel investing or venture capital or more private equity. And what that looks like is, can I buy a company and can I help operate it to make more money and to give myself a dividend or to grow the company? One of the things that I really do like with AI disruption on the horizon here is a lot of the local trades companies. Every small town in America has an electrician, a plumber, a construction company, right? And you know what AI is not going to be able to do? AI will not be able to do plumbing. AI has a really hard time doing electrical work, right? These are jobs that right now have to be done in the physical world. So when you look at your portfolio, you got stocks and bonds, yes, but have you tried emailing your local plumber and saying, do you want to expand? I'm looking to invest money.
Yeah.
Right. And so there you go. If you want an off the wall idea, go talk to an electrician or a plumber and say, can I buy you another truck?
Yeah.
And can I be a partner in a business? Right. I'm not saying that they're going to say yes. Right. But you'll probably be the only person emailing them that week offering to buy them a new truck to expand the company.
Yeah. No, that's a good idea for sure. And you're right. It's going to be very hard to disrupt that with AI. I mean, there will be improvements in some of the technology that maybe tools they can use that were originated from AI, but somebody's going to physically have to do the actual work. So
exactly. Yep.
Yeah.
And that person's getting paid a lot of money in some places right now. Some states I know it's like $150 an hour minimum for electricians, right? And that's real money.
For sure. How about any advice, anything that you recommend when it comes to the vehicle that you're going to be investing in? An example would be like a self-directed IRA or just investing, from cash, investing into 401k. What any particular route that you find works well?
Yes. So I'm sure some of your listeners have heard about the Peter Thiel story on how he totally lucked out with a Facebook investment inside of a qualified account and is now sitting on billions of dollars in a retirement account. And there's lawmakers going, well, that wasn't the deal. You're not supposed to have billions of dollars in a retirement account. That's not how this is supposed to work. Okay, so look, sometimes that works out and people just luck out. I look at tax advantaged accounts as a way to invest. But there's obviously very bright lines and rules, especially around things like self-directed IRAs, right? Retirement accounts are meant for future you to use in retirement. The spirit behind those laws is to set you up in the future so you are not reliant upon the government for money. It is not for you to have money now. And it's a very important distinction because when people start managing self-directed IRAs, where I usually see folks get tripped up is they start conflating future you and present you. Present you is the person earning money today. Future you cannot pay present you money, right? And anytime present you puts money into future you's account, that is something that the IRS takes a look at. And so that's important, right? Because if you're doing, real estate in a self-directed IRA, there's a limit to how much you can do on that real estate yourself because future you technically owns that, right? And so you're not supposed to be getting benefit today from future you investing. There's also rules around what you can put in terms of capital injections, right? This is usually what people refer to as your retirement account contribution limits every year. And when you are doing something in a self-directed IRA and you hit a need for capital, there are very real limits for where you can get that capital and what you can put in today. And I say that because I've been in certain real estate deals where there was a capital call, and folks who are in self-directed IRAs have a hard time meeting a capital call because it's often greater than the amount of money that they can contribute in any 1 year into a retirement account. And oftentimes the self-directed IRA is fully invested, right? And so you can't really meet a capital call because there's no money, right? So just something to think about. Now, it's not to say it's a bad idea to do self-directed IRAs or anything like that, but these are just some caveats that I've seen happen in the real world, right? Where someone was like, oh, well, I can't meet that capital call. You're like, well, what do you mean you can't meet the capital call? They're like, well, I don't have any money in the IRA and I can't contribute enough to meet the capital call. And you're like, oh, yeah, that makes sense, right? But you don't think about it when you're listening to all these people on Facebook saying, invest in a self-directed IRA.
Yeah, makes sense.
The other thing I'll say is, I love cash accounts. Just investing out of cash. I've got, a sizable taxable investment account. And yeah, it sucks to pay taxes every year. It does. But when you pay taxes, it means you made money. And ultimately, the game we're playing here is not pay the least amount in taxes. The game we're playing is make the most money. And so taxes should always be secondary to making money. Cut what you can, pay as little as you can legally, sure. But don't go and do something for the tax benefit, right? Do something because you make money and then deal with the taxes.
That's right. How about from a tax standpoint? Obviously, you're not a CPA, but just anything specific or anything that people should maybe be aware of or consider when it comes to potentially being able to save some of what they're earning on their investments from a tax standpoint.
Yeah. So I would say first things is if you are actually looking at optimizing your taxes, definitely go talk to a CPA, right? Yeah. Tax code does change every year and it's highly state dependent, right? So there are certain tips and tricks you can do depending on your state that you're in that allows you to actually, remove some state taxes and maybe even some federal taxes. In the case of Minnesota, where I'm located, we have a great tax benefit on our 529s, right? So this is one of the things that I always look at that hey, look, if you're going to be paying for your kids' education and you want a tax break, have you considered putting money into a 529? Right? There's a whole host of reasons why it's a good idea, but on top of it, if you make under a certain threshold in the state of Minnesota, you also get a tax break, right? And it's just there's some no-brainers like that where it's oh, well, I was going to pay for my kids' schooling anyway. Great. 529s can be used for, non-college education expenses too, right? Oh, you send your kid to private school. Have you considered the fact that you could be getting a tax break and still paying tuition, right? And, so it's stuff like this where you can go talk to a CPA and say, well, here's what I'm currently doing. And a good CPA will say, great, if you just instead funnel the money in through this route, you pay less in taxes. Yeah. Right? And of course, that's something I get to do as a financial advisor. Sometimes I catch that and I go, hey, by the way, not a CPA, but here's how I read this. Go talk to your accountant, double check, make sure I'm right, because I'm not allowed to give you tax advice. Right. But this is what I do. It's one of those, 99% of the time this works. Just go triple check it because I'm not legally allowed to tell you it does, right?
Right.
But yeah, it's those little things like that, right? If you're going to be giving money away, right, think about the best way to give money away. If you're going to be paying bills for somebody else, there's probably a tax advantage way to do it if it's something that society wants, right? A lot of our tax code is optimized for things that society wants more of, right? Being a landlord, there's a great opportunity there to take some non-cash deductions in terms of depreciation.
Right.
Even more if you become a real estate professional, right? So again, like it's little things like that where you start to look at, okay, what does society need more of? What am I already doing? Is there a tax efficient way to do this?
Yeah. Yeah, I think all things definitely to consider. How about any particular? Obviously, somebody should consider hiring a professional and using a company like Fireweed Capital to help them when it comes to growing their wealth. Is there any other tools, maybe from an app standpoint or something that helps with kind of getting maybe a better view or handle on, what your finances look like?
Yes, and I'm smiling because this is actually something we do for all of our clients.
Okay.
Every one of our clients gets a free subscription to Monarch Money. It is a great app. I don't care what budgeting app you use, get a budgeting app. And what I see a lot of folks end up doing is spending way too much time in the budgeting and not enough time in the reports. So the way that we use Monarch as a budgeting app is we basically look at your spend and then we craft a budget based on your actual spend, right? What we usually like to do is like about 3-4 months worth of spend because there's always that one-time expense. And that one-time expense always occurs every year. And so you have to take that expense and divide it by 12 because it's not a one-time expense. And I've been guilty of that. You go on a trip, you blow a couple $1,000s on a trip, and you go, well, that was a one-time expense. And you look back and you go, I've done that every year for the last 5 years. That is not a one-time expense.
Right.
That is a recurring expense. But really what we're looking for in those reports is, are you consistently taking in more than you are spending? And that's really the first indicator we look for. Are you on the right path to building wealth or not? If you are consistently spending more than you take in, either we haven't captured all your income sources, or you are slowly building debt, right? Or you might just have that rich uncle or aunt that you haven't disclosed to us, right? But that's really like those reports, that's what we look for, is just, does it all balance out in some way, shape, or form? And if it doesn't, that is a red flag for us as financial advisors, because we want to know where that money's coming and where it's going. And the worst thing to see is you're spending more than you make, you don't have a way to increase your income, and your credit card debt's going up. Like that's like the death spiral for wealth building. Like not only now are you paying way more than you should, but like just game over the minute you're in credit card debt. Like that is the number one thing to get out of, right?
Yeah.
So budgeting apps. Now, what I will say is an anti-pattern. Don't spend all your time making a perfect budget down to the dollar. Oh my gosh. A, you're never going to keep it. B, you're wasting your time by not thinking bigger, right? You're arranging the budget you have. You should be thinking bigger instead of sitting there, making the most of the dollars you have. Get more dollars. More money solves everything, right? Like you have a bad budget, great. Go make another $100,000 a year, and your budget doesn't matter, right?
Yeah.
So like focus your energies on making another $100,000 a year instead of optimizing for $10 here and $20 there, right? But by and large, you just need to know, are you in the green or in the red, right? And just track that every month. Some months you're going to be in the red, some months you're in the green. But that is like the biggest thing that we do. The second thing then, not necessarily an app, but it's good training to have as you think about building wealth, is go take a course on the difference between a profit and loss statement and a balance sheet. Because if you spend $100,000 every month and your budgeting app picks that up, that you're spending $100,000 every month, but what you're really doing is buying assets every month at $100,000 a month, that is a way different story, right? And if you can't distinguish between the two in a budgeting app, where you're just transferring money from cash to an asset versus a cash to an expense, and like that's like the number one way that I see people using budgeting apps wrong, because you're actually building wealth. You're not spending money; you're building wealth.
Yeah. No, it makes sense. And yeah, I think that's a good exercise for sure for people to go through. How, Adam, can people find out more about you, find out more about Fireweed Capital if they want to inquire with you or maybe have a consultation with you?
Yeah, so you can find us online, fireweedcapital.com. You can also email me directly, adam@fireweedcapital.com. I do answer emails. And yeah, basically the way that we work, I'm always happy to chat finances with anyone. Really what we're looking for on our first call is just, are we aligned, philosophically? We exist to help families figure out what their goals are, how they get to their goals, and frankly, make some more money. So we're not going to be there telling you to cut your spending. We're going to be there telling you to find more money, make more money, and certainly that's how we look at our investing philosophy as well.
Fantastic. This has been really good. I've got two more questions for you that I ask every guest. One would be any advice you would give somebody who's maybe just starting out in their investment journey?
Yes, get started somewhere. Just build the muscles of saving money. Your first million is the hardest million you will ever make. And this also scales down, right? Your first $100 is the hardest $100 you'll ever make. The first 1,000 is the hardest 1,000. And let me tell you, some people, and I've got friends who are very, very wealthy, they will tell you, the first million was the hardest. And now a bad day, a bad month is losing $1 million, right? Because they're worth 10, 20, $30 million. And when you hit those numbers, right, the ups and downs and those swings in your portfolio is larger than most people's net worth. So you just gotta get started somewhere, right? By the time you saved your first 100, a $10 swing isn't going to matter that much, right? Your first 100,000, a $1,000 swing isn't going to matter that much, but you just got to start.
Yeah, I think that's great advice. How about a book recommendation? Doesn't have to be finance related, certainly can be something you've read that's been impactful.
Yes, and I happen to have this on my desk because we talked about this before we went live. But yeah, so for those who are maybe watching, but it's called The First Tycoon. It's the story of Cornelius Vanderbilt. It is a thick book. It is about his entire life. For those of you who do not know, Vanderbilt was an incredibly successful businessman. Vanderbilt University is named after him. He was one of the first big players in American business. I did a lot of studying of some of the very wealthy businessmen in American history because I wanted to understand where they started. It's easy to start as a millionaire and get a second million. But I wanted to figure out, where did the guys start that had $0 to their name? And so this book, The First Tycoon, actually goes through how Cornelius Vanderbilt made his first money. And for me, it was incredibly helpful to be like, oh, that's how you build a massive multi-billion-dollar empire, right? And it actually goes through and talks about it. Like literally, he buys a boat and he starts moving goods in a boat. And the next thing he does is reinvest in a second boat, right? And it's like, oh, light bulb, right? Like, where does he spend his money? He doesn't go off party. He goes and reinvests in his business. And pretty soon, like after a couple of years, he's like, oh, I have like a fleet of boats. And you're like, light bulb, there you go. That's the beginning of an empire, right?
Yeah.
So that's I love history books like that because you start to see how people figure out how to build their empires. What does that first 3 years look like?
That's awesome. Yeah, well, you've sold me on the book, and that's the first one that was recommended. First time that particular book has been recommended. So fantastic, Adam. This has been awesome. I really enjoyed having you as a guest on the Wealth Flow, and I think we'll call it a show. Thank you so much.
Thank you so much.
All right. If you're still here, I assume that you found value in today's show and with the guests we interviewed. Please take a minute to subscribe and to review the show. It really helps. Also, wanted to remind you to check out Bobo Capital Ventures to get the first look at our 3 new cutting-edge, first-to-the-market investment opportunities. We have only about 15 spots for each fund for retail investors, and we would love more than anything else to have our audience be part of that group of limited partner investors. Thanks for listening to The Wealth Flow, and have a great day.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.